Hey everyone, let's just dive right into this explainer. If you're prepping for your intermediate exams, you already know the deal, right? Knowing the theory just isn't enough. You've got to be able to execute these calculations flawlessly, especially when the clock is ticking. So today we're tackling Practical Calculation Part 2. We're going to take those complex rules from the Companies Act and accounting standards and basically turn them into easy, repeatable steps. Let's get into it.
Here's our roadmap for today. We've got 1. The Calculation Masterclass, 2. Buyback statutory limits, 3. A solved scenario for those limits, 4. Cash flow, direct versus indirect, 5. Examiner tips and pitfalls, and we'll wrap it up with 6. A final 30-second summary. Let's not waste any time.
Section 1, the Calculation Masterclass, Securing Your Marks.
Look, the pressure of these upcoming exams is completely real, but mastering these specific, complex calculations, that's literally how you separate yourself from the pack. We are going to prioritize direct, step-by-step application of the rules today. Why? To make absolutely sure you avoid the common pitfalls that constantly penalize students. You see, examiners aren't just testing your memory. No way. They want to see if you can navigate the nuances of the law when a bunch of numbers are thrown at you. So, by focusing on high-yield application, you're making sure every single minute you spend studying translates directly into marks on your paper.
Moving on to Section 2, Buyback Statutory Limits, Understanding the Section 68 Framework.
Okay, let's tackle our first major hurdle, and this is an absolute exam favorite, by the way. I'm talking about the statutory limits for the buyback of shares under Section 68 of the Companies Act 2013. According to the Act, a company can only buy back shares out of 3 specific sources. You've got your free reserves, your securities premium account, and the proceeds of any shares or other specified securities. Now, it is absolutely crucial to remember that you cannot buy back shares out of the proceeds of an earlier issue of the same kind of shares. They evaluate statutory compliance strictly here, so really lock these 3 sources into your memory.
Now here's a fascinating legal trap, and students fall for this all the time. It's the definition of free reserves. As per Explanation 2 of Section 68, the term free reserves explicitly includes the securities premium account for the purpose of this section. This is a classic trap. When you're calculating your resource limits, so many people just forget to add the securities premium to the free reserves. So make a mental note right now, it is included. Remembering that one little detail will instantly save you from a super frustrating calculation error later on.
All right, Section 3, Solve Scenario, Buyback Limits, Applying the Rules.
Theory is great and all, but let's see how this actually looks on an exam paper. To find the maximum allowable buyback, you rigidly follow, and I mean rigidly follow, and calculate 3 distinct statutory tests. First up is the shares outstanding test. You cannot buy back more than 25% of the total paid-up equity capital in a financial year. Second, the resources test. This limits the buyback to 25% of paid-up capital plus free reserves. And third, the debt-equity ratio test, meaning after the buyback, your owed debt cannot be more than twice your capital and free reserves. That's the famous 2-to-1 rule. You have to calculate all 3, no skipping.
This brilliantly illustrates a scenario from our source material where a company is testing their limits based on 2 totally different loan situations. If we compare the 2, the shares outstanding test gives us 30 crores, the resources test gives us 24 crores. Notice those don't change regardless of the debt. But take a look at the debt-equity ratio test. If the company has a loan fund of 3,200 crores, the test allows for 32 crores. But if their debt is heavily inflated at 6,000 crores, the test suddenly yields nil. Why? Well, because their post-buyback debt-equity ratio would already exceed that 2-1 limit, which prohibits any buyback entirely. So let's say 24 crores is your absolute lowest limit across those 3 tests. You then take that rupee amount, divide it by your planned buyback price per share, and that gives you the final volume of shares. In our specific case study, that final mathematical calculation gives us exactly 28,750 shares, and that's it. That is the absolute maximum that can be bought back. Statutory compliance dictates that you must always select the least of the 3 calculated test results. Whether your tests say your capacity is 30, 24, or 28 point whatever, you must base your final answer on the absolute lowest figure. That guarantees you don't violate any of the 3 provisions.
Let's jump to Section 4, Cash Flow, Direct versus Indirect, Navigating Accounting Standard 3.
Okay, let's pivot to another heavy hitter to really build your exam readiness, cash flow methodologies under Accounting Standard 3 or AS3. It is absolutely vital to draw a hard line conceptually between the direct method and the indirect method. The direct method is exactly what it sounds like, right? It evaluates major classes of gross cash receipts and gross cash payments. You are looking directly at the actual cash coming in from customers and cash going out to suppliers. On the flip side, the indirect method starts with your overall net profit or loss and then requires careful adjustment for non-cash items, things like depreciation and changes in working capital. So you're essentially reverse engineering your cash flow starting from your profit.
Move in right along to Section 5, Examiner Tips and Pitfalls. Protect your score. Let's look through the examiner's lens for a second to see exactly where students unnecessarily lose marks, basically by anticipating the tricks hidden in the exam questions. For instance, let's step briefly into AS14, Accounting for Amalgamations. This simulated examiner's note highlights a massive conceptual trap. Purchase consideration is defined strictly as the aggregate of shares, securities, cash, or assets paid by the transferee company to the shareholders of the transferor company. Did you catch that? Therefore, only payments made to shareholders count. So if a problem tells you the company paid off the debenture holders, you completely ignore that amount when calculating the final purchase consideration. It's a distractor.
Let's quickly round up these traps so you can avoid them. Number 1, misclassifying the securities premium. Remember, for Section 68 buybacks, it is a free reserve. Number 2, mishandling non-cash items in AS3. If you are using the indirect method, you absolutely must add back depreciation because, well, it reduced your net profit but didn't actually cost you any real cash. And number 3, including debenture payments in your AS14 purchase consideration. Don't do it. Honestly, if you can sidestep these 3 specific pitfalls, your score is going to dramatically improve.
Finally, Section 6, Final 30-second Summary. Synthesizing the core takeaways.
Okay, take a deep breath. Let's consolidate everything we've talked about into a rapid-fire summary to really cement this for the exam. Ready? In under 30 seconds. When calculating maximum buyback under Section 68, you run the 3 tests and the lowest result wins. Under that same section, remember the law explicitly includes securities premium in your free reserves. For AS3 cash flows, the indirect method works backward from net profit, while the direct method looks at gross cash movement. And finally, for amalgamations under AS14, your purchase consideration calculation is strictly for the shareholders. Debentures, they do not count.
So as you sit down to tackle these practical case studies in your upcoming intermediate exams, I want you to look at every single numerical problem and ask yourself a provocative question. Are my statutory limits properly calculated step by step, or am I falling for a distractor? Don't rush the process. Trust the framework, remember those exceptions, and you're going to totally ace these practical calculations. Good luck with your studies, keep that focus sharp, and I'll catch you in the next explainer.